20 years of Wall Street Week with Louis Rukeyser is made possible by The Travelers, insurance and related financial services working to provide financial peace of mind for American business. By Enron, providing natural gas which holds the promise for a cleaner world and a more energy-independent America. Enron Corp. And the Enron Foundation. And by Prudential Beige Securities, rock solid, market-wise.
Your host for Wall Street Week is Louis Rukeyser.
Good evening, I'm Louis Rukeyser. It was 20 years ago, before Dan Quayle, before Federal Express and fax machines, before cable television or personal computers. It was precisely 2 decades ago that I hosted the first edition of what for millions of viewers would become a weekly staple. How long ago was November 20th, 1970? Well, it was a time when there was a vicious argument going on in the United Nations about whether Red China should be admitted. It was a time when Americans were prohibited from owning gold. The Vietnam War was still raging, and the Dow Jones Industrial Average had yet to reach 1,000. The Beatles had broken up several months before, and I hadn't quit my day job.
Good evening. I'm Louis Rukeyser. Tonight we're going to take a close look at the high cost of living. Most Americans call it their #1 domestic problem. They are angry and confused. We're going to see if we can find out who is responsible and what you can do to help stop it.
Well, we were all younger then. I was working as network television's first economic commentator for ABC News, after many years as a political and foreign correspondent for newspapers and TV all over the globe. And I was just moonlighting as host of this fledgling program until 1973, when I left ABC and went out on my own. We've had a regular Friday night date ever since. Unfortunately, for true connoisseurs of ancient styles in hair and clothing, no one kept a videotape of our first program back in 1970, or of most of those in our first few seasons. But we'll have plenty of giggles along the way for the sadistic during the next hour anyhow. During the first 3 years of the series, as it happens, we went off the air during the summers, and it wasn't until October 1973 that we went year-round. In fact, for the first 13 months of the program, we weren't even national. Until January 1972, we were seen only on stations of the Eastern Educational Network, a loose consortium of public broadcasting outlets that extended from the Canadian border to Washington, D.C. The program proved unexpectedly popular in a nation hungry for useful pocketbook information, and it wasn't long before we started attracting national attention and big-name guests. H. Ross Perot voiced a concern back in 1973 that could be echoed today.
First thing we've got to do is realize that the market is only liquid if the individual investor is in the market. Now then, a lot of people that used to think he's a nuisance would love to see him down there today. The big institution was very attractive. He's still attractive, but he must have the small investor too. He's essential to provide liquidity in the market.
Many in Wall Street would now belatedly say, Amen. We're light years technically ahead of where we were when we first went on the air. During one program in 1973, we lost our picture because a hunter shot out the video feed we were sending of a man who would become one of our favorite guests, Merrill Lynch's Bob Farrell. And America got only his audio. I've heard of people objecting to a picture on television, but this was ridiculous. And it was, we think, an accident. That sort of foible doesn't happen very much anymore, thankfully, because there have been a whole host of great moments that we wouldn't want to lose. Take that time in November 1975, when 2 of the world's leading economic figures, men whose influence would grow even greater in the years ahead, were my guests in consecutive weeks.
Paul, let's turn to the rest of the economy. You said earlier this year that you would be mightily concerned if the deficit in the federal budget went over $80 billion. According to Congress's reckoning this week, it's likely to top $72 billion. How concerned are you? Is this likely to destroy our recovery from recession?
Well, I think it's big. I don't think it's going to destroy the recovery from the recession. The trouble with these deficits is not so much the size of the deficit today, when there's a lot of unutilized capacity in the economy. But are we on a course that carries us continuing along with these kinds of deficits as the economy does recover? And the economy has begun to recover. It's been recovering rather vigorously for some months. And it's certainly time looking ahead to begin seeing reducing that deficit. And I would remain very disturbed if those deficits don't get reduced as we move ahead and as the economy moves ahead.
We have to balance our social aims and desires against our investment needs. The more you spend in the social area, the less you'll have to spend in investment. Investment means jobs, and you're going to have to watch your trade-off here. The more you go for one, the less you'll have in the other. And the only way you can make it up for your social aims is to have the government of the United States spend the money. And therein lies the problem. If the government decides to come into the capital markets in a large way, there's less capital available for everyone else. If the government cuts back on its desires, there will be enough capital to go around.
And not a word about Nancy Reagan and her astrologer. Over the years, we've done 956 programs with nearly 700 different guests, and no one could possibly count the number of predictions made here. Some of them have been amazingly accurate.
Charlie, how serious is the energy crisis?
Lou, it's large. It's going to be with us for a long time. It's going to be a fact of life which we have never experienced before, which is going to change our way of life and the future of our industrial society.
And then it's my own personal belief that you're going to have an acceleration in inflation. And I believe that the period of the 1970s will go down as the worst period of inflation that this country has ever had.
Even in the 1970s, when investing in stocks was out of fashion, there were still some brave souls who correctly saw the great bull market of the 80s coming all along.
Edson, some people incorrectly regard you as a bear because you were correctly pessimistic at certain key junctures, including 73. But in fact, you've just given us a pretty optimistic viewpoint, and I've heard you talking about even higher figures for the ultimate future. Do you still see 3,000, 4,000, 5,000?
Oh, yes, every generation has its big bull market that blows off. We had it in the 20s, we had it in the 50s and early 60s. We'll get it in the 80s and 90s.
Do you think that in the 80s we will be twice or more where we are now then? Or 3 times, 4 times?
3 or 4 times.
This will be the last century, last decade in this century in which you can buy the Dow Jones below 1,000. The last decade.
Les, how long do we have to wait for 2,100 on the Dow?
I think within the next decade we'll see that.
As the 80s began, stocks still languished, but there were some courageous bulls who bought when others wouldn't.
Last August, I had a comment about the Dow being at perhaps 1,700 by 1985. But 3 years ago, I made a guess, and this was strictly a guess, that I thought the Dow in this decade might be somewhere between 2,500 and 3,500.
I am quite positive about the stock market over the next decade. And I see a stock market in a historic perspective that is very, very undervalued in terms of fundamental things like book value and earnings. And to me, if we just return to a normal multiple in the next decade, which is 14.5 times earnings, and have only 3% earnings growth, you'll see the Dow in the neighborhood of 2,500 to 3,000 10 years from today.
How high are we going to go?
I would say there's a better than even chance that within 6, 7, or 8 years we will see the Dow Jones Industrial Average sometime above 3,000.
They laughed at Templeton's prediction then, but they aren't laughing now. In the fall of 1981, many of us chuckled at one of the most unusual guests we've ever had around here. But some of his seemingly wacky predictions turned out to be astoundingly on target. I'm a little confused. You said we're in a bear market, but earlier you said we were going to be in a bull market. When do we get out of this bear market and into that bull market?
The end of the bear market, the earliest I can count it is about August 26, 1982. It might be a little later.
Will we go lower than we've been between now and then?
Probably. But I'm not one of these 600 boys. I think 750 to 770 is more like the range of the final low.
August 26, 1982. Now, how do you pick the day like that? And can you tell me precisely what time Eastern
I use
Daylight
about
Time?
7 or 8 methods. The count from the middle section, the standard time spans, which appeared in the Encyclopedia of Stock Market Techniques. But usually, picking the exact day of a low or a high is usually done by the count from the middle section.
Your predictions are so specific and so long range that I think the remarkable thing is not that you're sometimes wrong, but that you're ever right. I think it's absolutely incredible. Lindsay was right almost to the day. The bull market began on August 13th, 1982, with the Dow at 776.92. Just after the bull market began, we had one of the most widely followed stock market strategists on the program, and he saw the long-range picture clearly. Barton, is this big summer rally for real?
Yeah, I think so.
Why?
Well, I think it started from a level when stocks were as cheap as they've been at any time since the 1930s, and the combination of that plus the combined in interest rates has given people some confidence that the world is going to hold together, and that the decline in inflation is meaningful, and that the 80s are going to be a decade of appreciation for long-term financial asset prices.
Barton, you have been saying that for a long time. Why did the market suddenly agree?
It finally saw the light.
And there was other good counsel along the way. Is this a real bull market, or is it just a short run?
It's been a bull market since 1974. I think that it is going to continue to be a bull market into the late 1980s. I think we are in a period that is similar to the 1949 to 1968 period, and we will keep going until most stocks are overvalued, until stocks are really popular with and overowned by both the individual and the professional investor.
How long do you think people should sit with stocks?
Well, I think it varies. There are some bull trends that last 8 or 10 years, and there's some bull trends that only last a year or two. Right now, I think for the big stocks that joined the bull market in 1980, and I'm talking about the big blue chips that are in the Dow, I think that they are going to be the leadership stocks going into the late 1980s.
The 80s were a great decade for stocks and bonds, as Barton Biggs and Bob Farrell predicted. But there was a frightening interruption during 1987. And the very Friday before Black Monday, one of our panelists saw it coming.
I haven't been looking for a bear market per se. I've been really in my own mind looking for a crash, but I didn't want to talk about it publicly because it's like shouting fire in a crowded theater, and there's other ways to play it. You just tilt your strategy negatively and you shut your mouth. I don't look for a long bear market here. I only look for a brief decline, but a vicious one.
Zweig has one of the best long-term records in the business, and courageous calls such as that one have added to his reputation. In fact, by early the next week, the market crash had indeed hit bottom, though comparisons between 1987 and 1929 were everywhere. The following Friday, with gloom and panic all around, I began the program by trying to calm everybody down and put things in perspective. Okay, let's start with what's really important tonight. It's just your money, not your life. Everybody who really loved you a week ago still loves you tonight. And that's a heck of a lot more important than the numbers on a brokerage statement. The robins will sing, the crocuses will bloom, babies will gurgle, and puppies will curl up in your lap and drift happily to sleep, even when the stock market goes temporarily insane. And now that that's all fully in perspective, let me say, ouch, and eek, and medic. Guests on this program regularly make predictions about the industries they cover. And looking back, an impressive number of them have kept our viewers years ahead of the crowd.
And one of the remarkable features about the semiconductor industry, in addition to the volatility to which Dan just referred, is how much they have brought down the cost of their products, a rarity in the inflationary era. A transistor costing $20 in 1960 now has its job done by a much smaller transistor that might cost a tenth of a penny. Are there dramatic technological advances like that still in store?
Yes, we're really, I think at the beginning, this is almost a new industry. It's only 28 years old. I think we have really barely scratched the surface of what can be done with semiconductors. The secret of growth is what you described, constantly lowering costs, which offer constantly lowering prices. And I think the technology is in place to keep prices going down for at least the next decade.
I gather that the hot new word in the industry is microprocessors. Would you define it for us and tell us why it's hot?
Yes, a microprocessor is most simply a full-fledged computer on a single chip of silicon about 1/5 of an inch by 1/5 of an inch. And it is a revolution in computation. It allows you to have a computer for the price of about $10. And I predict, Louis, that 5 years from now you're going to have a microprocessor in your home, in your car, on your wrist, in your telephone, and perhaps in other places.
Well, I certainly hope not.
I think the movie industry for the next, let's say 3 to 5 years in terms of theatrical viewing in theaters, I believe it's going to continue to be approximately flat. In other words, $2.5 to $3 billion a year will be spent on it. However, I think that the actual viewing of movies is going to increase dramatically as it has been doing over the last 5 years. This is going to happen on video cassettes. This is going to happen on pay cable.
In 5 years, what's going to be the most significant difference in TV from today?
In 5 years, what's going to be the most significant? There will be 4 major networks.
Fox will be the 4th? Wolfgang Demisch, who has just been made a vice president of Morgan Stanley, is making his 4th appearance in 4 years on this program, which shows what we think of his consistently highly rated analyses of aerospace and defense stocks. On his last appearance as my guest in May 1980, I asked him what further events might be anticipated on the international security scene, and he replied, and I quote, "Well, God only knows, Iran invading Iraq, Libya trying to bump off President Sadat, various things which affect our interests fairly directly." Wolf, that kind of precision in public forecasting is rare anywhere on any subject. What does your crystal ball tell you now about the international scene?
Well, I'm hopeful peace will break out as we proceed during the course of the year.
Demisch was a little early, but remember, you heard it here first. Alan Greenspan has been a frequent guest, and an outspoken one, too. It seems to me you're suggesting that we are going to go a little bit downhill in this world. Is that correct?
I think so, yes. I think that when you begin to look at the world of the 1990s, I think the United States comes down a notch or two.
Will we live worse or just live not as relatively better?
I think not as relatively better. Look, you know, there's a lot of talk about the United States losing its sort of per capita income leadership in the world. But the real issue is that the average American household has got the best homes in the world, it's got the best sets of appliances, the best telecommunications. The average American still lives far better than the average anything else. The trouble is that the gap, which used to be huge, is now beginning to narrow. It's going to narrow further.
Thank you, Mr. Chairman. I could go on all night about some of the great people we've had on here, or some who thought they were. Two of our viewers' favorites, and mine too, are a couple of old friends, Milton Friedman and John Kenneth Galbraith. Among world-class economists, the short and the long, the right and the left. Milton, we only have about a minute left. Let's see if we can hopscotch a little bit. Should we abolish the Federal Reserve Board?
Yes.
What would you replace it with?
A computer.
And what would you tell the computer to do?
I would tell the computer to see to it that the money supply goes up at exactly 2% per year, or as close there to as it can manage, on a week-by-week, month-by-month, year-by-year basis.
Is there any form of government regulation that you favor?
Absolutely. There are many forms. I favor the form of government regulation which says that if you murder your wife, you go to jail. I favor the form of government regulation which says you have to drive on the right side of the road.
Ken, you've never lost faith in the power of government to cure economic ills, but most of the country apparently has. How do you explain that?
Oh, there's no doubt about that, Lou. My generation is responsible through the Keynesian revolution, the welfare revolution, A great many Americans, a majority of Americans, have become comfortable, happy, and inevitably conservative, at least those that vote. And one notices that while people have lost faith in government, as you say, that doesn't apply to when some measure of affluence is involved. There's been no loss of faith in government when it comes to bailing out those S&Ls. No loss of faith in government as far as Social Security is concerned. Farmers are still committed to a very great faith in government for maintaining price supports and farm income. But I would point out that the faith in government is still very high, except as regards the most unfortunate of our people. And I would like to see a little more faith as regards them.
As any regular viewer knows, around here we don't just talk about stocks and bonds. Anything that affects you and your money is grist for our mill. And over the years, we've discussed the dramatically changing world economy with some of the planet's most powerful business executives, here and abroad.
Bill, whatever possessed your bank to make so many questionable overseas loans?
Well, I think, Lou, you have to put this in a perspective that we are indeed a major international bank, engaged in an international banking business, and that it is our job to make productive loans. And by and large, if you look at history, the loans made overseas were for productive purposes, were for good, solid programs for economic expansion, which were not only important to the recipient countries, but indeed to the entire free world.
I understand that, but surely when the door is shut and you're talking to your staff, you must be doing something to make sure this doesn't happen again. What are you doing?
Well, I believe very strongly that the problem you refer to is manageable, is indeed being managed and solved.
How much of this overseas debt, in your judgment, will never be paid back?
I think all of it will be paid, or what I would rather call serviced.
Well-managed banks have ridden through the greatest roller coaster in the last 15 years that anyone has ever seen and come through extremely well. So I think the fear is misplaced.
Well, why did you make so many bum loans to third world countries?
Well, the interesting thing about the bum loans is that they are all being serviced and paid, while the good American real estate made to people who spoke English in Chicago are in deep, dark trouble.
Are you saying that this is not a problem that's going to land on the American taxpayer?
No, it will not land on the American taxpayer. Some of the loans will not get paid, just as some will not get paid in every other sector of the economy. But the relative size of those, opposite the relative size of assets, is getting smaller every day.
Akio, is Japan an unfair player in the world economic game?
I don't think so, because maybe that is a difference of the viewpoint. For example, from us, sometimes American looks unfair. For example, American auto manufacturer comparing Japanese auto export, but on the other hand, they are buying from Japan automobile under their label every year increasingly. So such attitude for us looks unfair.
With his company's market share eroding, General Motors chairman Roger Smith came on the program in 1987 to predict an end to GM's slide. Roger, why is GM losing market share, and when, if ever, is that decline going to stop?
Well, I think what's happened, of course, all of us have been caught up in this worldwide competitive business. I think all you have to do is look at steel, electronics. It's a very, very tough world out there now, and certainly we've lost some market share, but I think we're about ready to turn that around with some of the new products we're bringing on stream.
Since that broadcast, GM's share has fallen further, and Roger Smith has retired as chairman. In March 1985, in the same week he was on the cover of Time, Boone Pickens, the most feared corporate raider of his time, came on to defend his form of investing.
Boone, you say you're the champion of the small stockholder. The British corporate raider, Sir James Goldsmith, says, and I'll quote him, that he does it, says takeovers are, quote, for the public good, but that's not why I do it. I do it to make money.
Isn't that really your number one motivation?
Lou, I'd be sitting here lying to you if I told you that we did not expect to make money out of these deals. At the same time, if you'll go back and look at what we've done with the stockholders, and, you know, if you just take the 4 deals we're talking about, there was $13 billion in profit. That profit went right back into to this economy. And it's moved around very quickly, some back into stocks and whatever else, but it creates jobs. It does a lot of things in America. So I like to see that capital moved around, and I like to see people make money off these deals, and they do. I don't like to see managements that their stocks sell at a huge discount to appraised value. That does annoy me.
In putting this program together, we were most surprised and delighted by the discovery that some of the best investment ideas came not necessarily from guests and panelists, but from viewers. Most weeks we answer 3 letters from viewers, and yes, the panelists do know the questions in advance so they can research their answers. There have been some truly memorable questions over the years. Frank Cappiello, Alan Ehrlich of Coram, New York, says he's looking for what he calls undervalued growth stocks, and he'd like an opinion of companies involved in the video games and video recording industry. Can you give him an answer live?
Well, I think so, Lou. Video games is the rigging of your television set to play electronic hockey or electronic tennis, and it's a growth area. 3 million sets sold last year. That's up 10 times from 1975. But it's a tricky area. And the company I like in this area, and I think there is growth here, would be a company called Warner Communications. This is a company that not only has a fine subsidiary, Atari, which produces the games, but also has other things, motion pictures and so on. Selling at 6 times earnings, I think it's undervalued. Video recorders, this is an entirely new area, about a year old as far as the residential home market is concerned. The leader here in taping TV shows and showing them again on set is Sony with its Betamax. Fine operation, but I much prefer the Matsushita system, which RCA will market very shortly. And it's a good way to play the system. And RCA may be a good turnaround candidate.
Father Randall, speaking of the political campaign oratory, here's a highly appropriate question about pollution control. Austin Calderwood of Rockford, Illinois, is looking for good investments in that area, either now or after the election. Could you clear the air for him?
Yes, I think investments in pollution control long-term and even short-term might be very beneficial. It is a growth industry here to stay. Companies like Browning Ferris, Peabody International, and others, Waste Management, could be very interesting. They have done well. They're not selling at low prices, but I think they're good investments.
Other prescient viewers asked about investing in robotics in 1978 and cholesterol-reducing drugs in 1984. Keep those cards and letters coming, folks. One viewer was thinking globally back in 1980. Frank Cappiello, Beatrice Crumhorn of Huntsville, Alabama, says she's heard that some of the world's best investments today, including mutual funds, stocks, savings accounts, and currency, can be found in the Far East, Japan, Singapore, Hong Kong, and elsewhere. Just how safe is this area of the globe for investment, she asks. What is your advice?
Okay, she's right. The Western Pacific countries are going to be the wave of investment success in the 1980s. There's a lot of possibility out there. That goes from Japan down through Malaysia, the Philippines, and last but not least, Australia. There is a better way to do it, less risk, and that is to buy a mutual fund. There is a mutual fund that concentrates in the Western Pacific companies, and that's called Merrill Lynch Pacific Fund.
Merrill Lynch Pacific has been the second best performing mutual fund since the date of that program. And whose fund has been the best? In 1982, a shy New Englander, hardly known outside the investment business, made his television debut on this program, and the rest is history. Peter Lynch is smart, hard-working, and humble, a rare enough combination in any business. And he believes the small investor may actually sometimes have the best information, but fail to use it. Obviously, the typical investor, as an individual, doesn't have the time to spend all the time you spend on all this, but is there anything he or she can learn from what you do?
I'm amazed that the average investor is out there in some industry. They're in the polyvinyl chloride industry, they're in insurance, they're in textiles, and they're going to see those industries turn. And they're not going to buy those stocks. They're going to go buy some stock from somebody in the National Guard, or they're going to something on television on biogenetics. They have a big edge in me. I work awful hard, and they're months ahead of me. They can be in the healthcare industry. They're seeing new products. They should work on that they have in front of them.
As they used to tell writers, write what you know, you're telling them buy what you know.
Yes.
What would you tell them not to do? What do you think are the mistakes people make?
This is a common mistake I do. I think people buy stocks because they've fallen from price X to 2/3 of X or half of X. On that basis alone, they're buying a stock. That's called bottom fishing in the stock market. Very, very difficult. I've had a rough go with it. Standard Oil Ohio this year fell from 90 to 60, and I told everybody, this stock is not going to go any lower. Then it went to 50. I said, this is it, no lower. As it went through 40, I said to people, this is it. Finally, when it got down under 30 and people said, what do you think is Ohio? I said, what does Ohio do? I don't know that company. See, I absolutely backed away from it.
You didn't like to buy low. Last spring, Peter Lynch retired from running the Fidelity Magellan Fund. But to our joy, he still comes back to visit us. Over the years, we've had some wonderful predictions from panelists and guests, but as I often point out, nobody in this business bats 1,000. And we've had some prognostications that are best forgotten.
You have used phrases rather more severe than the economy turning down. You've suggested that we may have the worst depression in our history.
Yes, I have said that we probably would have a worse depression than the 1929-33 depression. But even that isn't an apocalypse. You know, I lived through it. You didn't. So I know what it was like.
I caught the end of it, John. Howard, the back of your book says that you predict a major economic downturn, probably starting this year, with a 70% chance it will become a full-scale inflationary depression. Do you now feel that our current episode will not become a full-scale depression?
Not this current one, no. In the book, I indicated that the other 30% probability was we'd have a recovery from this one more time, then we'd move into that inflationary depression. Right now, I'd say it's 60-40, that we're going to find ourselves in a recession from which we will have an inflationary recovery. But I think the real inflation is going to take off sometime toward the end of 1981, which will lead us into an inflationary depression.
Do you think we're really going to have a gold standard?
Very soon. It's inevitable.
How soon is very soon?
Well, very soon means before Reagan's first term is up. And the movement to it, I believe, will begin before next spring.
And how could we talk about the sublime and ridiculous without talking about our old friend Joe Granville? Joseph Granville was the hottest newsletter writer in the business in the late 70s and early 80s. When Joe paid his first visit to Owings Mills, he was confident as ever.
When we announced we were going to have you on the program this week, we got a lot of mail from readers of your newsletter, not all of whom were entranced. Let me just quote from one of them. One of them quoted your January 16th letter, in which you called for a bullish breakout. The market that day, incidentally, was higher than it is right now. And you also said, and I quote this, "I have absolutely no doubt as to my ability to be right on the market. I cannot foresee ever making a serious mistake again in the market." Well, you made a mistake there, didn't you?
It wasn't serious, though.
Well,
Now,
how bad does it have to be serious?
All right. I'll bet you right now, Lewis, that letter came from an option player, because they're the greatest worriers there are. And I write a market letter, not an option letter. Mm-hmm. And we get people in at bottoms and out at tops. We got people in November.
Less than 2 years later, Granville was back.
I only have one judge, Lewis, and it's called the market. Yeah. In other words, when we go under 900, the verdict for Joe Granville will be not guilty. I have one theory, Lewis. Again, it's to put you into the bottom and take you out at the top.
Granville missed most of the beginning of the bull market in the early 80s, but in 1984, with the Dow at 1220, he was back.
Now, nobody knows the day nor the hour. Certainly I don't. But I do know that it is very, very late. Right now, I've been doing research for the last year and a half on a growing number of what I call 1929 parallels. Most of the time when you mention that year, people's eyebrows go up and say, oh, that's never going to happen again. As a matter of fact, a front page story in the Wall Street Journal on October 12th this year, just last month, was that all our top economists and Nobel laureates and so forth see no depression coming.
Let me stop you right there. You're the same Joe Granville who told us in 1982 that you didn't want to mix in fundamental analysis with technical analysis. You're the guy who said, what does the economy have to do with the stock market? Nothing. What do interest rates have to do with the stock market? Nothing. Now, when you've been wrong about the market for 2 years, suddenly you're back to fundamental analysis.
Louis, we would be frightfully dull if we weren't subject to change and flexibility.
And Joe has certainly changed. We're nearly out of time. We need one sentence from you, the most important lesson you've learned in the last 3 years.
Humility.
And the evidence of it is so overwhelming that I can see the lesson has been very well learned. Thanks a million, Joe Granville. It's always a joy to see you, and we'll check up on you again in your next incarnation, whatever that may be. Say this for Joe, he never gives up and is still publishing his market letter. There have been a couple of incidents around here that show, in case anyone was in doubt, that even I don't bat 1,000. Take the February night back in 1987, when I composed a series of Valentine's Day odes and then tripped over my own poesy. And finally, let's really get out the perfume and lace for the most adorable creature of 1987, the stock market. Only Shakespeare, I fear, will do. So let's try, how do I love thee? Let me count the ways. 1900, 2000, 2100, 2200. Keep it up, baby. You're beautiful. The following Friday, I admitted that I had gone down swinging. Okay, first things first. Let's stop all those great poets and shocked English teachers from spinning in their graves. For this was the week when I finally found out what you people out there really care about. And as a result, tonight I have to make my first public correction in 17 years of Wall Street Week. As hundreds upon hundreds of literate viewers have triumphantly, nay, gleefully pointed out, I was less than entirely accurate last week when, in the course of offering some Valentine verses of my own, I suggested that the sonnet, including the words, how do I love thee, let me count the ways, was by Shakespeare. From every corner of this noble land, by post, by phone, by telegraph, viewers rushed to shout, gotcha, shame, and at last. Many, to be sure, tried to be kind as they happily stabbed at my high school report card. As Mary Sutton Gilchrist of Syracuse, New York, affectionately put it, how do we love you? More ways than are countable. Your talent with verses is just insurmountable. But one, your last, I admit, left me frowning. That wasn't Shakespeare, it was E. Barrett Browning. Others, not so generous, fired at me with verse that was not so much blank as point blank. Wrote Joseph Carlton of Palo Alto, California, roses are red, violets are blue. Louis Rukeyser made a boo-boo. Proving that I can occasionally be as imperfect in geography as I was in English, I once welcomed a guest from Atlanta as follows. Don, welcome. Delighted to have you north of the Mason-Dixon line. As any high school geography student knows, and as many viewers gleefully pointed out, Maryland is south of the Mason-Dixon line. Maybe I was thinking of Wall Street. Sometimes guests have had a hard time finding their way to Owings Mills, Maryland, which for the curious is a suburb northwest of Baltimore. One guest didn't make it until the program was well underway. I had hoped at this point to go over and find that out from Harry Brown.
I'm sorry, Lou. His plane was delayed in New York.
Yeah, we heard I was afraid that was going to happen. In 4 years of doing this show, we knew this was going to happen some night. He's not here. We thought he was going to come in during the show. He missed one plane, and his later plane apparently getting from the airport to here was delayed in traffic. I hope he's going to show up before we go off the air. Meanwhile, I'm going to take these buzzards over, and we're going to talk about his book anyhow, and hope he comes in to defend himself. Welcome. Hi. Nice to have you here.
Glad you got here. Take the train next time.
I'm happy to report that on future visits, Harry Brown arrived in plenty of time. And so far, in the 16 years since that incident, we've never had a late guest. We like our guests to offer some investment suggestions to viewers, but one 1980 guest went too far. Asked for his best recommendations, he picked up a piece of paper and rattled off no fewer than 66 names.
I've got a whole list.
We're patient.
Number one on my list, if you don't mind me looking at it, just... I do it again in alphabetical order. I like very much Alaska Interstates, American Airlines, American Hoist, American Express, Apache, CSX Corporation, Kodak, Firestone, Fisher Porter, Flexivan, Franklin Mint, Frontier Airlines, Monsanto, National Semiconductor, Natomas, Oak Industries, Ogden, Upjohn, Warnaco, Westinghouse, Zapata, Zaire, Zenith, and Zimmer Homes.
And some of those companies are still in business. One notably outspoken guest in our early years was economist Pierre Renfrey, who has just been an unsuccessful candidate for governor of New York.
People haven't wanted to face the facts of life. If you look at the testimony on the pipeline from Alaska, so that we can get the oil into the United States, the main consideration they had was whether or not the caribou could jump over the pipeline. And we had to have a big argument about we were going to melt the permafrost. I'm dead serious. We're going to melt the permafrost and whether or not you would build ramps to have the caribou go over the pipeline. Now, I'm a very frank guy. I am not particularly interested in the caribou going over the pipeline. I'm more concerned about the ability of 212 million people to make their economy go.
2 weeks later, to show our impartiality in such matters, we went to Washington's National Zoo to see if we could find a caribou willing to come on the program and discuss Pierre Renfrey. We couldn't, but 3 years later, Mario Cuomo's favorite Republican returned to pull his punches once again.
I think you've got to start off with the basic concept that what we've got, what the country is offered economically is what I would call the do-everythings, which are the Democrats, and the do-nothings, who are the Republicans. You've got one group who have all heart and no intellect, and that's the Democrats. And then you have the Republicans who are all intellect and no heart.
In 1989, we had a memorable program on the future of television on the 50th anniversary of its birth. Former NBC President Pat Weaver and legendary producer Grant Tinker spoke about how television has changed. Pat, you influenced the first 50 years of American television as much as any man. What do you think of the state of the product today?
Well, I've complained a number of times about the withering of the promise, because we really did have a tremendous thing going in the 50s after a bunch of us who had run the real radio business, the program business, went over and took over the facilities network that the radio people had been, and made it into a program service with a grand design that we all really believed was going to revolutionize society. And it worked so well in the 8 years that followed that they kept the formula, but they turned the cameras on not the real world that we were trying to cover in many different ways, including entertainment, but also too much of the movie studio product.
A friend of mine who has been a long-time television executive maintains that commercial television has to operate under what he calls Gresham's Law. Bad programming drives out good programming. Most people want to watch trash. Do you agree with that?
Well, to some extent I do. And I also agree with Pat that we have sort of abdicated what could have been our television and given too much of it over to what he called the studios. I think of it as too much fiction and too little fact. And I think he and I should be comforted by the future in that regard. I don't really understand the hardware of television, and I certainly can't look ahead to what it will become, but it's obvious that television is now so pervasive, can go anywhere, bring back anything, that I think we will now redress the balance to have less fiction and more fact, and that we'll be bringing the world, in effect, into everyone's living rooms, and to that extent, we will be driving out perhaps some of the witless and forgettable fiction.
We have 26 panelists on this program. 2 of them, Frank Cappiello and Carter Randall, were on the very first program. Pete Colquhoun was an original, too. Bill Waters and Julius Westheimer joined in our second year, but the others have all been guests first. And that's how our new panelists are chosen. We thought it would be fun to take a look at some of their memorable debuts.
Actually, investor expectations are simply the study of what investors expect the market to do. And you may ask, why is that important? Well, I'll try to give you a brief example. It doesn't really make any difference what causes investors to think bullishly or bearishly, at least from my standpoint. I only care that they are bullish or that they are bearish.
Nothing is 100% sure, but with technical analysis, you can see trends. You can see basically where there's support or resistance for price and volume characteristics, and once the trend is in motion, it will stay in that trend until there's a bigger force.
First of all, Louis, I don't believe that any analyst should identify him too much with any one theory. I don't know of any person who's really succeeded for a long time in this business who's locked into one specialty only. But I am a custodian of the General Motors Bellwether, partially because these years' custodians make more than brokers some years.
I expect that both newspapers and television will probably continue to maintain or slightly increase their market shares at the expense of other media, primarily magazines and direct mail.
Well, I think the most significant things that are happening actually are below the surface, in the sense that the words that are used, the buzzwords that are used, are inflation, interest rates, tight money, and things of that sort. I think what really the market is attempting to define is a great deal of concern with a significant underlying fundamental change that has occurred in the U.S.
A technical analyst studies the supply and demand factors in the stock market. And we do that by studying price fluctuations and the corresponding volume patterns. Now, that's the work that we do on individual stocks. In studying the market itself, yes, we do, again, study the fluctuations as registered by the various indices, but we also delve into what business cycle indicators affect or correlate well with the market, what monetary factors affect a market.
Well, our short definition is that a growth stock is a company that's capable of producing earnings growth and dividends growth in excess of the general growth of the overall economy. Over the last 5 years, as a matter of fact, growth stocks did grow.
What I try to do is find companies that fall into, I guess, what you'd call the inefficient sector of the market. So much of Wall Street's research is done on an industry basis that very frequently there are companies that fall between the cracks of industries, so aren't covered and therefore may be unrecognized.
I don't understand all of the methodology of most market timers, so I guess I can't really respond to their approach. I guess my concern is that when I would put all of the market timers together, for example, if we were to go out and tally up all those people who are trying to make some sort of a market timing approach and contrast their performance to those people who are so-called stock pickers or bottom-up managers, they haven't outperformed the market either for most periods of time.
I think a wonderful piece of investment advice today, offered with all due humility, is to get out of debt. What the world seems to want to sell you is a second mortgage. That is the latest vogue among the debt peddlers, and it seems a wonderful thing not to take on.
With 20 years to our credit, it's nice to see that we've been accepted as part of American culture. We long ago lost count of the number of sitcoms that have mentioned us in their scripts, but we do recall a memorable 9-minute parody on Saturday Night Live. Wall Street. There is a striking resemblance, isn't there? Even if he did have a little trouble pronouncing the name Rukeyser. Not to worry, I was 11 before I had the hang of it myself. One of the enjoyable things about doing this program for 2 decades is that it affords us a chance to look back. Earlier this year, we established the Wall Street Week with Louis Rukeyser Hall of Fame to enshrine guests who have been special favorites of our viewers. 4 men were clearly the audience's first choices. 2 of them, John Templeton and Peter Lynch, were guests on last week's 20th anniversary program. 2 of them couldn't be, and it was our loss. Malcolm Forbes was a great writer, raconteur, and lover of life. He liked to say, "I so dig living that no one will be sadder when I'm dug under." Malcolm, welcome. We're just delighted to have you with us.
Oh, it's a pleasure.
Please.
After that build-up, I'm a little trepidatious.
Don't you be trepidatious. I know you're intimidated, but take it easy. You may have a career if you do well tonight. Malcolm Forbes is often called the happy capitalist, and one look just now will tell you why. In addition to his notable holdings, he's the chairman, he's the editor-in-chief as well of Forbes, a business magazine founded in 1917 by his father, a Scottish immigrant. It's now one of the largest and most respected in the field.
Malcolm, you were born rich. You've become a heck of a lot richer. But most of the public attention, as I already suggested, is centered on the way you've spent all that money. Now, your father, they tell me, was a pretty tight Scot. How would he feel about all this publicity?
Well, I'm sure he wouldn't mind the publicity. It's the price that would bother him.
Was he stingy in expenditures? Was that your household atmosphere?
No, he wasn't stingy. He was stingy in non-essential expenditures, of which he considered over-generous allowances in that category. I remember whenever we left the living room to go into dinner, we were all taught to turn out the lights on the way into the dining room. He wasn't stingy, he just had a great respect for money, and I've developed a great affection for it.
Well, what is your attitude toward money?
That it's a very nice thing to have.
By far our viewer's favorite guest, and mine too, if the truth be known, was a fellow named Merrill Stanley Rukeyser. We waited until 1984 before giving him his first shot, by which time I figured that the viewers could trust me not just to be showing you home movies, and that it really wasn't fair to keep a qualified guest off just because he happened to be the host's father. As soon as he appeared, viewers wanted to know why had I been hiding him and when would he come back.
Wall Street's never been popular, and it's an easy plaything for the demagogues. And I think that those who speak about fairness and the fairness of an incumbent president and a tax bill are not only attacking the incumbent, but they're attacking the whole system, because the nature of a competitive system is inequality. We pay people according to their productivity. If you want to pay people equally, then I recommend communism. They promise it, they don't always perform it.
Well, at 87, you belonged to one of the constituencies that was singled out for special attention this week. How do you feel about being described as a senior citizen?
I resent it. I'm against hyphenated Americans, whether they're German Americans or Jewish Americans or Italian Americans or gay Americans or sober Americans.
I mean, you think you're just a citizen. The big story this past year in the economy was all the corporate mergers. Have we ever had this before?
Yeah, we've had mergers before, but I think there's some aspects of it that need a little straightening out. I think it's a conflict of interest when management puts itself in conflict with the stockholders and makes a leverage buyout. They've been hired to work for the stockholders, not to trade against them.
You were quoted earlier this year in one magazine with something that still sounds pretty good to me. You talk about constants. You said, there's no sure investment, no chance of being right every time. All you have to work with is careful selection, persistent supervision, and diversification to cushion your mistakes. Successful investors know themselves and do their own thinking. They don't react to each market fluctuation. They find a good investment and let it pay off. Would you want to amend that at all now?
No, that was pretty clever of me. I didn't remember saying that.
Are you still a holder of common stocks?
I am, but I, with the advice and consent of my heirs and assigns, I took advantage of my age and bought a non-refund annuity so I could afford to hold common stocks that only paid a small rate on the purchase, the market value.
But when you were investing for your own account, you still believed in the future of the stock market?
Yes, and I believed that I was assuming certain risks. I didn't think I was making a riskless adventure.
You obviously were not a newsletter writer because they don't have any risk. They just tell us they know the answer.
Well, if you subscribe for about $60 to $80 a year, you can have this riskless adventure. The only thing is they run out of town after a big break.
Your life covers a whole cycle in American life in terms of our international position. We were a debtor nation, we became a creditor nation, now we're a debtor nation again. How can we become more competitive in America?
By a return to excellence.
Merrill Stanley Rukeyser lived his life striving for excellence. And though he's no longer here, that goal remains an inspiration for us all. 20 years ago, when there was no other program about money on American television, the prevailing view was that the subject of finance and economics was simply too dull and or too complicated to attract an audience larger than the capacity of your average telephone booth. The old telephone booths have virtually disappeared since then, but we're still here. Thanks for helping us these past 2 decades to put a little money in your life, and vice versa. With any luck, we'll keep on having fun and helping you make sense of the world of money for a long time to come. Meanwhile, this has been the first 20 years of Wall Street Week. I'm Louis Rukeyser. See you Friday.
20 years of Wall Street Week with Louis Rukeyser has been made possible by The Travelers, insurance and related financial services working to provide financial peace of mind for American business. By Enron, providing natural gas which holds the promise for a cleaner world and a more energy-independent America. Enron Corp. And the Enron Foundation. And by Prudential Bache Securities, rock solid, market wise. For a printed transcript of this program, send $5 to Transcripts, 20 years of Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. That's $5 to Transcripts, 20 years of Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117.
KPBS will be repeating 20 years of Wall Street Week with Louis Rukeyser Monday at 12 noon. And in our next hour, stay tuned for a special documentary, Brothers in Arms.
"20 Years of Wall Street Week with Louis Rukeyser" has been produced by Maryland Public Television, which is solely responsible for its content.
This is PBS.
We're the Berkeleys of Rancho Bernardo. We support KPBS, and we hope you will too.
And I second that.
The year is 2050. The greenhouse effect is no longer just a theory. The world is a very different place. James Burke looks back from the future with a startling report on life after the warming.
8 p.m. this Wednesday.
Next on Mystery, Albert Campion must protect a judge who's been marked for murder.
You're my last hope. My dear young optimist, what you're saying is, here's a nice war, come and join it.
I've got one end of the string. But if any of that crowd gets wind of it, my fear is that they'll cut it higher up, and I'll lose the one chance of stopping this thing at the head.
Mystery Mile on Mystery.
Watch Mystery Thursday at 9.
I know you so well.
Harry Connick Jr. He's young, he's hot, he's happening, and he's happening here. Harry Connick Jr. and his orchestra, next time on Great Performances.
Don't miss Great Performances Friday night at 9.
Believe it or don't. Some animals can sense an impending earthquake. Salmon find their way using their sense of smell. Elvis has been sighted living in a dolphin colony. You'll be amazed at what you'll learn when Super Sense continues with Super Sense and Beyond. Next time on Nature.
It's from me. She's a groupie. Policeman, turn around. Hello, Mona. What do you want from me? No, I can't come to your apartment. No, you can't come to my apartment. I'm married. You're sorry.
Corporations, including registrants with the Securities and Exchange Commission. Wall Street Week is also made possible by Union Bank. Union Bank is proud to support quality programming on KPBS. Union Bank, offering the personal service of a local bank with the strength and resources of a major business bank. At Union Bank, we bring it all together.
Louis Rukeyser. Is made possible by the financial support of viewers like you. By the Travelers, insurance and related financial services working to provide financial peace of mind for over 40 million Americans. By Enron, providing natural gas which holds the promise for a cleaner world and a more energy-independent America. Enron Corp. And the Enron Foundation. And by Prudential Bache Securities. Rock solid. Market wise. Produced Friday, November 23. Our panelists are Howard P. Colhoun, Mary Farrell, and Maceo Sloan. Tonight's special guest is Kenneth S. Hackle, President, Systematic Financial Management Incorporated.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week in which a world in revulsion against the 1980s turned in wrath and punished two of its icons. In New York, a federal judge handed a sentence of stunning severity to Michael Milken, once revered as a brilliant financial innovator, the genius of junk bonds, and the reputed creator of new wealth, new business, and new jobs. For transgressions that were, for the most part, so technical that few could understand or explain them, Milken was sentenced to 10 years in prison, more than 3 times what Ivan Boesky got for the blatantly crooked delivery of suitcases of cash. Never mind that Milken, who lived remarkably simply and gave lavishly to charity, turns out in the real world to be a highly flawed symbol of flagrant runaway greed. In a national mood of envy against anyone who makes more than you do, worst of all by being smarter, Milken made more than anyone, an eyebrow-raising $550 million one year, so naturally virtually everyone hated him, and few would take pity on his lengthy incarceration, disproportionate though it plainly seems, and obviously intended not so much to fit the crime as to induce him to spill other beans and produce other inmates. Hallelujah, the awful greedy have now been punished, and the rest of us, so morally pure, if financially poorer, can sit back in smug satisfaction. Mike Milken goes to the slammer for our sins. Nor is this mood of retribution restricted to American society. Across the Atlantic, in London, the ruling Conservative Party forced the ouster of Prime Minister Margaret Thatcher, whose terrible crime was that she had reversed 2 generations of national decline, courageously stood down socialists in her own ranks as well as the opposition, and given hope, prosperity, and an economic future to a nation that had long seemed in danger of losing all 3. Her ultimate felony was not so much the one that was alleged, insufficient enthusiasm for surrendering British sovereignty to a European bureaucracy, as the more familiar political offense of simply not knowing when to leave, and moreover being a bit rude to her would-be successors. Yes, it's true, Caesar was ambitious. And now a gaggle of Brutuses are squabbling over the inheritance in a newly troubled nation that faces an election no later than mid-1992. Those who remember history will not be surprised. After all, the British threw out Winston Churchill after he led the conquest of Nazism. Why shouldn't they do the same to Maggie Thatcher amid the worldwide retreat of Marxism? And so the mood of vindictiveness, the urge to slander and repudiate the 80s that was such a feature of the recent American tax debate, swept across the globe this week as nations worried that a declining economy was merely a symptom of a deeper malady. Gosh, folks, whatever happened to Thanksgiving? Well, around here, we're grateful for a lot of things, some of which actually did happen in the 1980s. And to add to your postprandial delights this holiday weekend, we'll be talking with a guest whose specialty is the reverse of the debt binge of the 80s. He likes to concentrate on cash. We'll tell you how he finds it and see if he can find some for you. But first, before everyone who had any success this past decade is publicly humiliated, let's see what happened on Wall Street in the week just past. And as the Dow Jones Industrial Average indicates, Falling interest rates took a back seat to falling profits and fears that the Persian Gulf crisis may yet erupt into an oil war. And so the Dow gave back 23 points to close at 2527.23. As investors digested recent gains along with their Thanksgiving turkey, it was the first week in a month that all the broader indexes were down too. Our elves obviously ate so much they couldn't move, and not a one of them changed a vote in our index of the market's technical prospects for the next 6 months. The dollar and the precious metals had a mixed week, with the standout performer being platinum, now pushing a 2-month high after 5 straight weekly gains. But the week's losers included the rock group Milli Vanilli, which had to give back its Grammy Award after the disclosure that its 2 members didn't actually sing a note on the record album or in the concert appearances that followed. So let me formally deny the vicious rumor that I'm just lip-syncing all these opening commentaries myself while Walter Cronkite talks into a microphone off stage. Girl, you know it's not true. Pete Calhoun, last time you were here, you warned us that war was coming in the Middle East. Any change in that forecast?
No, I'll stick to that, Lou. I think that the market is really too waiting for that outcome. It's what I call mega event-driven rather than interest rate or earnings-driven. The market wants to see some kind of clarity on what's going to happen over there, and I still think we will get enough troops there and they won't move, and we will, unfortunately, in terms of some casualties, have to take a step militarily.
How will the market react if there is war?
It'll go down, I think, on the day or the 2 days after it happens. I think that's a buying opportunity, and then you will see, with the kind of like the pressure coming off, the market will rise, and I would suggest that if that occurs, people buy on that 200, 250-point decline if such an event occurs.
You're assuming that we will have a quick and satisfactory outcome.
I'm not sure, but I think it will be fairly short, yes. I don't think we'll be drawn out. The worst case, I think, is for us to let this situation go on for months, if not years, with a huge standing force over there. That would be the worst case.
You've been very cautious about this market, but you think the buying opportunity is now coming?
It's coming. I think we're in a recession. I think we'll be in a recession for most of '91. The market will lead 6 months ahead of us coming out of that recession, so I look for a down, sideways market until about the middle of next year, Lou.
When do you think this war is going to erupt?
I would say before March.
Mary Farrell, do you think the market's just waiting for war, or is there something else going on?
I think the war is the definite overhang, and as long as that major uncertainty is out there without resolution, it does put a cap on the market breaking out of this trading range. But the other 2 problems the market is grappling with, and was before the Mideast crisis, are the recession and a very dismal corporate profit picture.
And those are not about to be overnight reversed?
Unfortunately not, but actually to put this in a different perspective, I think most of the financial press points out accurately that the market started tanking in July, which if you look at the broad indices like the Dow and S&P is true, but this market, if you look at a broader base of stocks, really peaked last year, and corporate earnings peaked in the 3rd and 4th quarter. So we may be much further through this bear market than we think, closer to resolution.
How far through do you think we are?
I think that certainly we're going to have 2 to 3 quarters of recession, but as Pete says, the market bottoms well before the economy or before corporate profits. So I think we could actually see a bottom 1st or 2nd quarter.
2 to 3 quarters of recession, and when did they start?
Well, the recession this is going to be debatable when exactly it started. I think if you look at corporate profits, which is a much more accurate measure of what's going on in the economy, you see that we've been in decline for a year.
Maceo Sloan, what's your view?
I would agree with Pete and Mary Lou. I think that when you look at the marketplace, the market has gone up, the market's going to come back down. It has not bottomed. I think that it's going to bottom sometime the 1st quarter of next year, and then we think that's going back up. It looks like to me a good buying opportunity is going to come along, and one that everyone should wait for, because when the market dives, it's a good time to get in.
How do we know when that moment is here?
If I knew that, I would be selling crystal balls instead of making forecasts. But I think that I can look at the marketplace and what it's done and see that there is some strength in the market still, even though all the recession worries and the deficit worries. And that's going to be realized in higher prices sometime down the road.
Would you expect that the stocks that will lead the upturn when it comes are those that have shown the most resistance to the downturn?
Not necessarily. I think that some of those stocks that have been absolutely crushed are going to be some of the same ones that lead the charge back up. when we look at the large cap stocks that are corporate favorites, I guess we would have to call them, or institutional favorites, some of those stocks have really been battered, and I think there's still some good value in some of those stocks.
What are some examples of stocks like that?
Well, I would stay away from the airline stocks and from some of the automotive stocks, but some of the consumer stocks, like your Cokes and your Pepsis, have been battered somewhat in this marketplace, but there's a lot of good value still there, and people are drinking those soft drinks, and the new markets have opened up for them with the opening up of Eastern Europe. So I think this is a tremendous buying opportunity.
Let's hope your forecast doesn't go flat. In any event, panelists, it's time now to give our viewers something to be thankful for. Pete Calhoun, Louise McGuigan of Fort Worth, Texas, wonders whether we've learned our lesson from the savings and loan debacle. She'd like to know what steps, if any, have been taken to prevent further damage from mismanagement of these institutions, and whether you feel those measures are sufficient now to protect the public.
Well, after the horse had left the barn, Lou, they slammed the door pretty hard, and they passed a piece of legislation called the Financial Institutions Recovery and Reform Act, which did three things to S&Ls. It raised the standards by which the things they could invest in, much stricter regulation, and it raised the capital requirements. So the way I see it, the people who were depositors are going to be okay, but the taxpayers have a very, very big bill to pay, that $500 billion that's sitting out in front of us. One thing that's very much misunderstood is that fraud has been pointed to as the major reason here, and that is not the case. It was the United States Congress that encouraged the S&Ls to go in these very liberal investments, and then after they found how wrong they are, they needed a scapegoat and blame someone else. So the bottom line is, if you were a depositor, you don't have to moan. If you're a taxpayer, you give a big groan.
Let me ask you something that wasn't part of this question, but is suggested by what you just said. Some people, including this week the Treasury Secretary Nicholas Brady, have suggested that regulators have now gone to the other extreme and are being too tough, as a result of which they're inducing a credit crunch that wouldn't otherwise be there. Do you think that's accurate?
That is absolutely so, and it's particularly showing up in the banking industry, where the banking regulators don't want on their watch what happened in the S&L, and they're putting new restrictions on banks and inducing a problem that wasn't there before. And part of this out of the S&L is they said they can't own junk bonds by '93, collapsing the junk bond market, making any sales that now must come at even lower prices. So you were right on.
All righty, Mary Farrell, Brian Sato of Fullerton, California, is skeptical about the recent better-than-expected government report on gross national product, the total output of the nation's goods and services, for the third quarter. He's curious about what specific indicators the government uses for this report and how much weight is given to each.
Okay. Gross national product is very simply consumption plus investment plus government spending. Each of these broad categories is broken down into a total of hundreds of other smaller categories. Consumption is about 2/3 of our GNP, by far the most important. It would take all night to break it down. But I think the important part of that question, and I'd like to note, is he is absolutely right to be skeptical about, for example, the third quarter GNP, which showed plus 1.8. And if I may just read, to give you an example of how bad these numbers are, they're all subject to revision. And first quarter 88 started out with a 2.3 announcement, then they said it was 3.9, then they said up 3.6, 3.4, 4.1, finally said, in fact, that quarter was up 5.1%. The ironic thing is that Wall Street actually pays attention to these numbers. Not only do we not know where we've been, we don't know where we are. How could we possibly guess where we're going? So keep up the skepticism.
I hope we don't have to revise your answer. Maceo Sloan, Steve Robinson of Charlotte, North Carolina, recently received as a gift a pair of boxer shorts imprinted with stock prices. This started him thinking about underwear in general and whether there might be, as it were, hidden profits for investors in this area.
Well, Lou, the underwear industry is a very mature, very stable industry. It doesn't have a lot of excitement to it. It's growing about at the same rate as the population growth, so we're not going to get a big bang for the buck there. However, when you look at the underwear manufacturers as a group, there are two that stand out that we would have to look at. One, I think Fruit of the Loom is my top pick. Fruit of the Loom is a company that is now selling around 7.5. It's been up as high as in the 15 range in the last 12, 18 months. There's no particular reason why it should be down like it is, and we think that's a good one. It's going to really grow. So I would recommend that one. For people that don't want to be directly in it, Sara Lee Corporation has Hanes underwear, and everyone knows about Hanes. But the apparel part of Sara Lee is only 32% of sales and 42% of their income, and the underwear division of that is far less. But it's a good industry. It's an industry that's out of favor right now, and it has a history of snapping back very hard when it comes back. So now may be a good time to buy.
Elastic demand. All right, if you are afraid of being caught with your pants down, we'll try to get you out of arrears and to a happier end. Please be brief. Don't bother jockeying for position, but just expose your bottom dollar questions to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, let's take a look at the system he uses to choose stocks. A combination of arithmetic and common sense that enables an investor to go with the flow. He focuses on free cash flow, which he defines as what falls out when you turn a company upside down and shake hard. It's similar to a family's disposable income. It is, quite simply, the extra money a company has to expand, to repurchase its own stock, or to increase dividends. But how do you know it? When you see it. Free cash flow is not the same as plain vanilla cash flow, a company's reported earnings plus such non-cash accounting charges as depreciation. And it's more than operating cash flow, a broader measure that doesn't take into account a company's need to repay debts, its capital spending, or its acquisitions. Real free cash flow includes many possible sources of cash, such as overspending on research and development, which he feels can easily be cut back, surpluses in the company's pension funds, and the earnings of subsidiaries that are reported to but not sent to the parent company. In short, all accounting tricks aside, he sees free cash flow as the maximum amount of cash a company can pay out in dividends or reinvest in future growth. The most complete picture you can paint, as he sees it, of a company's available or readily convertible resources. Who has it? And how can you get some of that cash in your bank account? For some thoughts on that, let's go over now and meet tonight's special guest, Kenneth S. Hackl. Ken, welcome. We're delighted to have you here tonight.
It's great to be here.
Until now, you had to have pretty good cash flow yourself to get the insights of Kenneth Hackl. His company, Systematic Financial Management, caters to the wealthy. For most investors, that has meant at least a $250,000 account. But his fine track record and his special insights into this kind of analysis have lately attracted broader public attention. Ken, no less an authority than Donald Trump, recently announced that cash is king. He may have been a little late in discovering that, but does this mean that the 90s will indeed be different from the 80s?
Well, I certainly hope not. Since the economic expansion began in November of 1982, corporate debt in the S&P Industrials grew by 12.6%. And when I say corporate debt, I mean short-term debt, long-term debt, and capitalized leases. Free cash flow for the S&P Industrials grew by about 9.6%. In addition to that, only a quarter of all public companies can repay all their debt within 5 years from their free cash flow. And the average entity has 72 cents of debt for each dollar of equity.
Well, you said you certainly hope not.
Yes, I hope not.
You hope that the 90s will not be different from the 80s?
Yes, I don't want to see that divergence between the growth in debt and the growth in free cash flow.
Do tougher economic times make it harder or easier to find companies with good free cash flow?
Well, it can make it more difficult, and it can, believe it or not, make it easier. When we analyze corporate free cash flow, we analyze the cash flow over 4-year periods. And what we have found that companies do is they cut back in their discretionary expenditures. They plug away on the balance sheet. They cut back on corporate overspending. Therefore, that frees up more free cash flow, bringing down the free cash flow multiple.
Are there categories of stocks that are good at having free cash flow, or do you have to nitpick them?
Well, one of the nice things about being a free cash flow analyst is it puts all companies on even keel. Because of the disparity in accounting regulations, using price-earnings multiples makes that disparity impossible. Yes, of course, there are certain industries which, by their nature, generate more free cash flow. But what we attempt to do for our clients is buy a diversified portfolio of such entities.
Where are you finding your bargains now?
Lou, when we invest for a client, we buy a diversified portfolio of cash flow generators. Now, the publishing industry is a excellent source of companies which are selling at very undervalued free cash flow multiples.
What are some examples of stocks in that industry?
Well, companies like New York Times, Meredith Corporation, and Times Mirror. Also important in this group is they generate somewhat consistent cash flows. And one of the problems of the 1980s was investors were investing on last year's cash flow and not looking at the consistency of the company's cash flows.
You've pointed to the publishing industry as one that looks good by this kind of analysis. Where do you find weakness? What should investors avoid by this analysis?
Well, I would avoid companies with high debt, negative operating cash flow, and negative free cash flow. Companies like Helig Myers, Grumman, Rohr Industries.
Do you think that we will, in the 90s, see far less debt in the debt-equity ratio?
Yes, I certainly hope so. And again, when the economy is in a recession, as it is now, I say that because corporate free cash flow has declined by about 13% year over year. Companies must work the balance sheet. They do so through attrition, cutting back on corporate overspending. They must reliquify the balance sheet, and that's something we're seeing now.
When do you think we're going to hit bottom?
Well, Lou, the recession started in the second quarter. It was picked up in free cash flow with the fourth quarter of last year. I believe we'll hit bottom probably in the first or second quarter of '91, depending on how lenient the Federal Reserve is in supplying reserves into the banking system. And not just this country's Federal Reserve, but the overseas authorities as well.
Would you wait to buy then, or would you start nibbling now?
Oh, no, I would absolutely buy now. And, in fact, we are buying now.
Let me let you talk to three people who brought a little cash with them tonight, starting with Pete Calhoun.
Ken, looking back at the 80s, the takeovers and the buying by foreign institutions made the performance of big capitalization stocks far superior to medium or smaller size capitalization. In fact, if you look at performance versus capitalization, the smaller the cap, the worse the performance was, and the bigger the better. Do you think that's going to continue here in the 90s? And if so, it's going to be different, why?
No, I don't think it will continue, but it had every right to be that way in the 1980s. And the reason was the low capitalization stocks sold at higher free cash flow multiples than the higher capitalization stocks. And they also had more debt per investment dollar than the high capitalization stocks. The value now, Pete, we're finding is, in fact, in the medium capitalization stocks. Capitalizations between $300 million in market value up to $2 billion in market value. It seems investors have not been looking in this area. Foreign investors and index fund buyers have bid up the free cash flow multiples of the high capitalization stocks.
And by some of the traditional measures of value, stocks aren't looking nearly as cheap as they've looked at other market bottoms. By your cash flow measures, because you say you're buying, does that mean that cash flow measures suggest they're cheap enough that we have reached?
That's true, Mary. The S&P Industrials currently sells at about 21 times free cash flow. That's typically near a bottom. I also don't advocate people invest in equities unless they have a 3 to 5 year time horizon. With that in mind, an investor should do very well in equities over that time period. As a matter of fact, we feel the equity market will double over the next 3 to 5 years if, as we suspect, free cash flow rises by 10% per year.
Ken, when you look at free cash flow, the average investor is looking at reported earnings. From what you're saying, I get the feeling that reported earnings is not a meaningful number. And should we do away with that number, or should the accounting board change the standards?
That's right, Maceo. There's a wide gulf between free cash flow and accrual accounting. Free cash flow is very much a leading indicator of good things and bad things. For instance, Todd Shipyards and First Executive Corp. Both sold at low price earnings multiples, had high return on equity, yet they went belly up. They went belly up, of course, because they were net borrowers, had negative free cash flow, and had leverage.
And following up on Maceo's question, Mary told us earlier to be skeptical of government economic reports. You've just told us to be skeptical of corporate earnings reports. What can we believe?
You can believe free cash flow, Lou. Free cash flow is the ultimate bottom line. Free cash flow allows that comparability. It's the only true valuation measure, and it is a leading indicator. In addition to that, in a period of slow economic growth, investors would want to own companies that have financial flexibility. Financial flexibility is the ability of a company to react to change and to take advantage of investment opportunities, both good and bad, for offensive reasons and for defensive reasons. You would not want to own companies that do not have financial flexibility.
You've talked to us about the danger of the debt that was taken on in recent years, but you've given us a very bullish forecast that the market may double in 3 to 5 years. How's that going to happen?
Well, it will happen because we expect the devalued dollar and world trade to flourish throughout the 1990s. And don't forget, the 1980s also started out as a turkey before it started to improve in the middle of the decade.
Well, that's a wonderful sentiment for Thanksgiving, and a lot of people hope you're right. Thanks very much, Ken Hackle. Thanks, too, to our panel. And I hope that you will be back with us again next week. Then we'll see just how many reindeer Santa Claus is really going to have to lay off this year. My guest, Joseph Ellis, is the nation's top-rated analyst of the retail trade industry, and he'll be here to tell us what's looking good in the stores and also how the stores themselves are looking at Christmas 1990. And remember that all good little boys and girls are welcome to attend. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been made possible by the financial support of viewers like you. By the Travelers, insurance and related financial services working to provide financial peace of mind for American business. By Enron, providing natural gas which holds the promise for a cleaner world and a more energy-independent America. Enron Corp. And the Enron Foundation. And by Prudential Bache Securities. Rock solid. Market wise. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser.